An IFA, a solicitor, and a tax advisor walk into a bar. The solicitor says, "Why the long face?" The tax advisor says, "It's a cruel world." Oh, come on.
Yes.
Nothing.
No.
A cruel, a cruel.
Yeah. Yeah. Best jokes are the ones you got to explain.
Oh, no. Right, that'll definitely be cut out. All right. Aside from that horrifying opening gag, hello everyone, and welcome back to the Private Client Podcast. For those tuning in for the first time, I'm Charlie Chami. I'm an independent financial advisor at Glums IFA and a co-founder of the Private Client Network. We are on a mission to bring together different private client professionals so we can all improve the service to our clients, increase our knowledge, and grow our respective businesses. We're doing something a little different today, and if you're watching, you'll see that I'm being joined by three wonderful professionals. If I could just quickly go around the screen and get you all to introduce yourself, starting with Heledd.
Hi. Heledd Wyn, partner at Private Client, Shakespear Martineau, based out of Bristol.
Excellent. Anton.
Hi, I'm Anton Lane, chartered tax advisor, running my own practice, Edge Tax, dealing with high net worth individuals. And we do anything from dealing with tax investigations at serious fraud level with HMRC through to consultancy for family wealth.
Awesome. And my co-founder, Simon.
Simon Tutton. I'm a partner at Waterspring Ventures, which is a venture capital firm investing into early stage companies in Wales and the southwest of England. And as Charlie says, a co-founder of the Private Client Network.
So we are 3 weeks into a new Labour government. They've started quickly and announced a host of things, a lot on planning, offshore wind, onshore wind, that type of thing. But we are all obviously concerned with what they are going to be introducing potentially, or what we might wish for in the private client space. So to kick us off, Heledd, you shared something on LinkedIn, and it was quite a weighty document on the care cap. I tried to get into it, but if you could give me something on the care cap, what's going on with that?
Short answer, not a lot.
Oh,
Slightly
no.
longer, slightly longer answer. Post on LinkedIn, there was a report published, I think it was last week or week before, actually pretty comprehensive explanation of how people pay for care privately. And this might be something that you might think, well, actually, I'm not too bothered about it because it'll never happen to me, but it might happen to yourself, it might happen to you or a family member or relative. And certainly in Bristol, Southeast England, Southwest England, care ain't cheap. You're talking, sort of £1,500, £2,000 a week care in a home at home. And there's pretty much no limit to how much can be paid out. The technical limit is 23,250. So if you get your entire estate can get wiped out to 23,250, technically slightly less, but 23,000 is the figure that most people go with. 10 years ago, Care Act came in. It was very exciting. There was going to be a care cap, which said actually people will only end up paying £86,000 for their care. So everybody got very excited about that, and absolutely zero has been done about it since. So there was huge excitement that maybe government would come in and start looking to implement it next year. But I think we're very much in the long grass. So to go back to my original question, I don't think very much is going to happen in the care space other than it's expensive, it's getting more expensive, and it really is something people need to be considering as part of their overall estate planning, tax planning, asset protection conversations with people like all of us.
Care home costs are eye-watering. They cause us in the sort of IFA space a real issue because you've got people with sort of decent amount of assets. They're keen to maybe pass it on to their adult children, but they've got this sort of lingering doubt in their head of what will retirement cost them, and specifically, what could care home fees cost? And it's really difficult because you may not need it at all, in which case you'll have a huge, potentially a big surplus of assets that maybe you should have passed on, or you could need all of it and you could be in a care home for years. And and wish that you kept hold of it. So it is difficult. £86,000 as a cap. I mean, that's a substantial cap for some people, because some people, if they're in for years, could go well over that.
Yeah, so the devil's in the detail on the cap. So care costs, you can effectively split into two parts. There's the bit that's actual care, which is where you've got somebody doing the sort of maybe assisting with activities of daily living, so getting dressed, feeding, or what have you. And then there's the accommodation costs. And that is by far the biggest chunk of the costs. A lot of people are referring to as hotel costs. So if you're paying for care fees, this 2,000, say it's £2,000 a week, actually only a small proportion of that £2,000 might actually be the care element and care component.
I see.
Certainly some care homes are pretty good. They'll split it down, and they'll send you an invoice, and they'll say, care component is X pounds, remainder is Y pounds. It's only X, which is the care component, that counts towards the cap. So you can have this small amount totting up towards 86,000, but actually a rapidly increasing sum of money on the accommodation costs, which has no cap, and that is between the care home and its residents. So it's not even that exciting.
Maybe not as, yeah. I mean, I suppose if care costs are only 20% of the overall cost at your stay at a home, yeah, you're still looking at a huge bill. I mean, that's a rather important detail.
It's a very important detail, one that's often overlooked. And because I'm quite nerdy, I sat down and did the maths about a few years ago when it's sort of been talked about again. And I think the average, and this is about 4 years ago. So, God knows what inflation's done to that. I think the average cost the average stay in a care home is going to be something like 6 years before you hit the care cap.
Oh, wow.
So
and I think the actual average stay is more like 2 or 3.
Yeah. So I wouldn't get too excited about it.
That sounds like the tactic, I think, when they brought in the state pension. I think they brought the state pension in at age 60 and life expectancy was 57 or something at the time.
Yeah, I think it's tiny. It's a tiny gap. I think it's like 3 years life expectancy when the state pension came in, and now it's 30.
Yeah, something like that. Okay, so maybe not quite as generous as it initially seems.
Sadly not. But I think that's really important, is that it's a huge part of the planning element. When you're looking at the overall estate planning, you need to look at the inheritance tax, the capital gains tax, the income tax, and care as a potential tax.
Yeah, when Labour manifesto and during the campaign, they made a very strong point, a very big deal about no changes to income tax, no changes to national insurance, and no changes to VAT. They were much quieter on what there might be changes to. IHT being one of them. I had a quick glance, and there's something about IHT and trusts. Does anyone want to touch on that at all?
Yeah, absolutely. So, I mean, currently, if you look at UK trust, then already within the these are trusts set up by UK domiciled individuals, or trusts where you have assets based in the UK. They're already in the scope of UK tax anyway. So that's not part of the proposition that Labour put forward. The proposition that they've indicated is that they would look to make all offshore trusts liable to IHT. That statement in itself is a little bit difficult, because when you say all offshore trusts, you've got to be referring to offshore trusts where you have somebody in the UK that's in the scope of tax, so a long-term resident, someone that's been here for longer than 15 years. Used to refer to non-domicile status, but I assume what they'll be looking at people with long-term residents, or offshore trusts that have UK cited assets, which would technically be in the scope of UK IHT anyway under the relevant property regime. The difference is that you used to be able to take UK cited assets outside the scope of UK IHT, but that's no longer the case. As far as the change goes, maybe for the long-term residents that have settlements that they set up before they became long-term residents that would be protected from IHT, that's a big factor. Although the last 5 or 10 years or so, I've seen some remarkable changes to the taxation of non-UK domiciled individuals, and many people with those offshore structures have either relinquish their involvement or their connection with them that would make them taxable, or brought them onshore and used things like family investment companies or invested in IHT efficient investments. So I'm not sure whether it's more a political move, moving on the back of what the Conservatives introduced for the long-term residents. I'm not sure it's such a big, going to reap such a big revenue for our UK government.
So offshore trusts at the moment, are they exempt from IHT?
Not really. It's the easiest answer to that. So offshore trust, so if you had a trust set up by someone when they were non-UK domiciled or a non-long-term residence, I use the two terms because people might not have got used to the sort of new definition, which is somebody who's been here for 15 years. But if you look at those trusts that are set up, they can be protected against UK IHT where they don't hold UK-cited assets. And they can continue beyond that individual's residency, long-term residency status. That's a sort of a change that would effectively disincentivize long-term residents or shorter-term residents who are going to become long-term residents from doing offshore trusts, because they would have no significant UK tax advantages. However, there are a number of other offshore structures, and I don't want to give away what people can do, but there's a number of other offshore structures, some of them in the financial world, some of them hybrid between the financial world and what we call the tax planning world, and then some pure tax planning structures that would all give IHT advantages, which even to this day for UK domiciled and long-term residents still have that advantage so long as they can be afforded. And I make that point because the offshore world has become more costly from a administration point of view. So it's only going to appeal for people with significant assets. I can't imagine many offshore structures being worthwhile to do with 5 million. So you're probably 5 million and upwards. And I think that is probably going to change to sort of 20, 30, 40 million and upwards. So it's going to be for the more wealthy, which
so I guess the scope of it to the sort of average person is relatively limited by the sounds of it.
Yeah. Absolutely.
So I mean, on the average person, have they announced anything to do with the normal IHT nil rate bans and things like that?
There's been lots of comments, I believe, in the press that there's going to be a review of IHT, maybe a reform of the IHT, and maybe more of a sort of a system that you see across Europe where you've got like a wealth tax and stuff like that. I had a look at the propositions this morning ahead of Charles asking me to join this, just to make sure I hadn't missed anything. And from looking at the website, there's no specific propositions there at this point in time. I don't know if Simon or Heledd, you've seen anything different, but I haven't seen anything apart from an indication that IHT might be reviewed, same as capital gains tax might be reviewed. Although when you look at the websites and what they're saying they're going to review a capital gains tax, the actual specific points they're making are quite limited.
Yeah, I think with inheritance tax, I mean, you know, the nil rate ban's not changed since 2009. You know, it's probably due a review, but if you think 14 years of Conservative government, they didn't change it, you know. And I think it's something like only 4% of estates pay inheritance tax anyway. So where's the incentive to actually deal with that? But whereas, you know, it is a decent source of revenue for those from those 4%. And actually the vast majority of estates don't actually pay it.
Yeah, I suppose as well, by not moving, I guess this is what is often referred to as the fiscal drag, by not changing the limits and not changing the exempt amounts, you just pull more and more people into that tax regime by virtue of doing nothing. And it's very hard to get too animated about a nil rate ban that doesn't change and just allowing people to fall into it. It just doesn't create kind of the negative headlines that governments want to avoid. So yeah, I think I don't see them making them any more generous, and they probably won't, or I suspect they won't reduce them either. They'll just let more people fall into it as asset prices go up and house prices go up. On any of those other, I guess the outside of the ones that I mentioned where Labour specifically mentioned not making changes, anything else on the main rates, CGT or other taxes? I know caused a lot of headlines was VAT on private school fees, but I suppose I don't know when that's slated to come in, but there's been an awful lot of noise. That is going to happen. It's just a case of when, I think.
So, I mean, I can run through a couple of them. I think, Charles, you've known me for a while now. The problem I have is I go off on a tangent and slip between taxation to political rants. I'm going to try and confine myself in that area. But for example, corporate tax is not sort of, they've said they're going to cap the headline rate at 25%. That's, where we are anyway, so nothing overly major. They referred to a sort of a business investment regime where they're going to look at a permanent full expensing system for capital investment. That sounds great, but we don't know what it is. We imagine that might, well, there's two things that go in my mind. One is that we will have a better expensing regime where people are reinvesting into their company the profits, which obviously means you're not taxing it when it comes out of the company because it's being reinvested, which sounds great. The downside of that as well, it strikes me there's going to be a potential advantage there for tax avoidance on reinvestment, like there has been for R&D. So along with that will come some sort of policing side.
Yeah, sorry to interrupt, but so the permanent full expensing of capital investment. So what's the current system, and what is the potential change? I'm not.
So the current system is capital allowances system. So where capital, and I can only sort of pontificate over what they might actually mean because we're waiting for obviously full information to come through. But the capital allowances gives a relief every year over a number of years until that capital expenditure has been fully relieved. So it happens over a period of time, where it sounds what they're proposing is a quicker, faster route of investing, which is effectively encouraging businesses to reinvest in their capital, maybe, for example, buying new machines. But there's also capital allowances rates that have been introduced, like first year allowances, etc., have all been there before. So it's not, it might be a headline, a political statement more than anything. We'd have to see exactly how that pans out, I would hope, by October this year. There are obviously things that are floating around that give an indication. It just sounds like it's going to increase in sort of expenditure by businesses back into their own businesses, which will have a good economic impact if enough businesses do it. And with any tax system, it's probably worth pointing out that you can look at, and Heledd made the point here with IHT, it's 4%. To change that sort of IHT regime, you would have to, and to collect it, you have quite a complicated system of collecting IHT, etc. Whereas if you increase gross domestic product, so you increase businesses turning over profitability and reinvesting and the like, then you increase gross domestic product and you increase your tax take even better. So there's a fine line between getting companies and businesses and individuals to reinvest, as well as how do you collect most efficiently. For example, the income tax system, or PAYE, and VAT are the simplest systems to collect taxes.
Yeah, I mean, it's interesting that, and I think that whilst people get quite animated about the kind of personal taxation things, it's actually a lot of the stuff that Labour seems to be doing on the growth side is possibly more important overall. I mean, in the venture capital world, EIS is very popular, and is in fact, the French have just introduced a very similar scheme to EIS because they like it so much. And that touches upon income tax, capital gains, inheritance tax. And it's difficult to pick apart what would be the impact of higher capital gains rates, whether that be a benefit or not to, an incentive or not to people investing in EIS. But a lot of the stuff that we focus on is the changes they're making to the data that's available to university spin-outs, and the founder track, where they're talking about having universities taking less equity in the business, and then the big pots of money that they've been talking about with the Mansion House pension reforms. And things like
I had that was on my list. So what is the briefly, what is the Mansion House pension reforms?
So it was something that's been talked about for a while, but Jeremy Hunt, love him or hate him, did finally manage to bring the big pension funds to the table and say that we're not investing enough in smaller companies. We need to get big wedges of our pension funds to do that. We are an outlier in terms of OECD countries, and where American and Canadian pension funds in particular invest pretty heavily in private equity and venture capital. Our pension funds don't tend to, and it could unlock possibly around £50 billion worth of investment over 10 years, which would be an absolute game changer in the kind of early stage entrepreneurial ecosystem, to have that money come through, hopefully in a clever and phased way. But it'd be an absolute game changer for the UK. We would very much be on a par with California if that happened.
I think it sounds similar to, and this was announced under the last Tory government, and I believe that the Labour are going to carry on with the plans for a British ISA, which is basically an additional £5,000 ISA allowance on top of the current 20, but with the stipulation that it needs to be invested in UK firms. It's an odd one, to be honest, because I don't know if it would happen with people investing their own money, but certainly professional investors. We often think about where money goes in terms of asset allocation, and we'll allocate percentages that we want in certain geographies or certain asset classes, i.e. shares or bonds or commodities or something else. And if there was a portion of a client's ISA that had to be in the UK, I could imagine what a lot of people will do is, like, say your UK allocation was 20% for your standard ISA, and then you're forced to have a UK allocation of 5,000 in this additional, you'll simply just keep the same UK allocation, move the 20% into this extra allowance, and then make sure, and then the primary ISA is still international. I don't know how they're quite going to avoid it. So the British ISA bit will get invested in the UK, but then people will change how they allocate elsewhere.
Yeah. It's a largely pointless headline grabber that Anton's smiling. Largely what they need to do is make the London and the LSE or London Stock Exchange an awful lot more attractive for companies to list on, so the UK fund managers actually want to invest in our companies. We don't invest in our stock exchange at the moment because the best investments are elsewhere. So hence why the allocations have shifted. Yeah,
I mean, on the investment front, there was a few things that the Chancellor Rachel Reeves has announced, and it was in the King's speech recently, all around pensions. So a lot of it was about the auto enrollment scheme. So just a quick recap: auto enrollment was something that was introduced by the coalition government under Steve Webb as the pensions minister. It was a scheme by which all companies were compelled to automatically enroll their workforce into a pension scheme. People had the option to opt out, but it was an active thing that they had to do. What they were aiming for is that inertia would mean that people wouldn't opt out, and therefore they would start saving into a pension scheme where they weren't previously. The rates of contributions increased slowly over time, and it's currently 8%, 5% which is coming from the employee and 8% from the employer. So what's been trailed in the King's speech and what they're looking at is there's a few quirks to the scheme. So for the moment, those contributions are calculated. So that 8% is calculated against the employee's earnings. But for some reason, there was an exclusion for people for the first £6,240. It's called the lower earnings limit, whereby the employer only had to pay that percentage on earnings above that. Now, if you're a person on £12,000 a year, that means half of your income is excluded. So one of the changes that I think will be likely to come in is a removal of that lower earnings limit, meaning employers will have to pay contributions on people's full income. And that will very much be on my wish list. I think it was a silly rule to begin with. And companies had the option to pay contributions on your full earnings, something we did, and I think a lot of companies did, but many didn't. Another tweet.
Go on, Charlie. Tell us what, because the limit's 8%. What should that limit be? Your financial planner.
Well,
tell us, what should people be saving?
Yeah, no, it's a really, really good question. So why do we bother saving into pensions? We are trying to ensure that we've got enough income or assets in retirement to provide us an income. the rule of thumb, and it varies depending on what kind of lifestyle, maybe you want a lifestyle upgrade in retirement. Maybe you don't. Maybe you want to plan for care costs. Maybe you don't. But the rule of thumb is that somewhere closer to 15% would be a much better amount for people to contribute into a pension scheme. That's obviously significantly higher than the 8% people are compelled to. But I suspect that 8% will be nudged up over this parliament. And again, I think it'll be slightly painful in the short term, particularly with cost of living. People don't necessarily want to have a slightly higher deduction from their pay packet. But I think that really that 8% contribution should be increased, and I think it probably will. And another little tweak is that auto enrollment was only compulsory from age 22 and above. That will likely be reduced down to 18. Again, a sensible move to make sure that people are saving enough for their future. The other thing on pensions that is likely to come in, and again, I think this is good. So all of these pension schemes that attract billions and billions and billions of pounds into typically get invested in a default fund. It's something that's either selected by an employer or a pension scheme administrator. Now, those default funds have got to be, in an attempt to be appropriate for everyone of every age, they are often not appropriate for many people, particularly often younger people who could take a little bit more risk in search of a better investment return. And I think there's going to be a bit more of a spotlight on what the default investment funds are for occupational pension schemes. Again, a good move, because people, particularly if you're younger in your career, you're potentially leaving a lot of investment return on the table by not having a more appropriately risked investment. So hopefully, I'd like to see a lot of those come in.
I mean, going back to the Mansion House pension reforms, one of the hopes from investing more money in venture capital would be that returns from for UK pensions would be higher. So there's a slightly spurious figure floating around of £11,000 would be the additional bump to each pot, which doesn't sound like a great deal of money, but essentially all of that comes from the potential increased returns by UK pension funds being invested in different asset classes to where they are currently invested. One question I've thought of, though, possibly for Heledd, is how does I'm not quite sure how to phrase this, but how does pensions interact with the planning for IHT and for care that you see?
I think it's a really important aspect, because I mean, just listening to some of the figures being sort of bandied around, when you're sitting there going, actually, it's probably not worth doing any sort of planning until you hit 5 million, thinking, actually, we're into that realm of, you're into that sort of extreme wealth, aren't you? The ultra high net worth space, which is absolutely fine. But, for those perhaps in that 5 million and under space, there's a lot of financial demand, isn't there? There's a lot of demand. There's definitely going to be inheritance tax payable. There could be care fees payable. There's probably going to be, a desire to send children through school and university, and perhaps help them on the housing ladder. And so, all that interaction between all the capital and the income, and particularly pensions. And if we're talking people with pensions, we're sort of, are we into that sort of baby boomer and down that end of people with different sorts of pensions perhaps now, that intergenerational flow, I think, is going to be really important. So, are people going to be able to go, well, actually, I've got surplus income because I have got a good pension, and I can start transferring that down? Or can I eat into my capital and start making capital gifts, with a view to reducing IHT? So I think, you have to look in the round between capital and income and what people's priorities are. And the conversations I'm having with clients is I sit there and go, okay, great, so what have you got and what are you worried about? And I'm worried about inheritance tax, and I'm worried about care fees. I said, well, we're all going to die, that's easy. Care fees less so, but actually the hit could be worse, because inheritance tax is only 40%, she says, but care fees can potentially be an awful lot more. And none of us know. So, for me as a solicitor, it's really important to sit down and work with other advisors and go, right, look, what have you got? How long is it going to last you? what are your priorities and what are your worries? And everybody's different. So, you know, talking to people recently the other day, they go, well, you know, I really like the fact that I've got a holiday home and loads of income and a big house in a very nice place, and I don't want to get rid of any of it. And so it's absolutely fine. Then there's going to be a big hit on your estate. But for you and your lifestyle, it's what you want. So it's really important that we talk to clients, and as a number of professionals, we work together and go, you know, what do you want? What are you worried about? Can you afford it? And how do we structure it in a way that works for everybody? And that's quite complicated. There's lots of moving parts. So yeah,
what's your go-to in that situation where people are really concerned, like the care home thing is looming large in their mind, and they do want to pass those us on? Well, like where could we bring you guys in, or other solicitors to help with that?
Yeah, I mean, obviously all other solicitors are available, but what we sit there and go is like, okay, genuinely, what are your concerns? Because we've got a toolkit of documents we can produce that have an effect. You know, they can be a deed of gift that divests money from your estate. We can transfer property that takes property out of your estate. We can create trusts. Again, it takes money out of your estate, but it doesn't go automatically to the recipient, and it could be a useful long-term vehicle for growth. We can do things like, you know, have difficult conversations going. If you really are that bothered about, you know, going into care, talk to your family about do not resuscitate orders. Do talk to them about, actually, if I end up in care, don't keep me alive. You know, these conversations are genuinely sit down and have them with people and go, because we can do there's powers of attorney for finance, which is quite straightforward, but the health ones I think are sometimes equally as powerful, in that if people, so you can sit there and go, okay, well, if I have this or this life limiting condition, do not treat it. You can also do advanced decisions known as living wills. And I've had clients have complete light bulb moments where they've gone, what, it's that simple? I can just say, switch me off. And I go, yeah, if that's what you want, and if you're that bothered, we can get pretty extreme about it. What I don't do is money, in the sense that I structure estates, do all the structuring. I don't manage the money that then needs to work.
Yeah.
So that's where working with financial advisors is perfect, because, you know, cash flow modeling, understanding how long that money is going to last in whatever circumstance is critical. Again, you know, working, you know, specific taxation stuff. Actually, clients have got a long-standing relationship. You know, Anton, you'll have a long-standing relationship with them. You'll know that. We can come in and do the consultancy bit and go, well, we can tinker around the edges perhaps with some of the stuff that you don't do. You do stuff you do, and then Simon and Charles do what they do. And, you know, between us, probably we can completely get clients to a point where they get what they want. We just need to extract from them what they want and apply what we know to that.
Well, I think it's quite important that you as solicitors, you will have a raft of solutions within your remit that some of it I will be familiar with, or sometimes touch on the borderline of advising on, but not that much. Some of the stuff that solicitors do will overlap with what we do, and there'll be a raft of stuff that we don't do. Neither Heledd and I will do anything to do with Charles and Simon's side, just because that's regulated. But you know, we advise on the tax side of some financial products. So if somebody comes to us with a you know, a query in IHT, we advise through to the tax implications on some of the regulated products, but then obviously pass the client through in a looked after way to an advisor like yourself. So I think that's where we all come from. We come from what's in the client's best interest, really, don't we?
Absolutely.
Yeah. I mean, that's part of the reason we started the network in the first place, because we were just so aware of how professions run adjacent to each other and overlap in certain ways. But actually the venue for us to all get together was, it is quite limited in some respects. And we do tend to go to conferences and seminars and events within our own sort of respective field. So it's kind of what we were shooting for, and hopefully shooting for this podcast as well. One final thought on the overlaps pensions and IHT, because at the moment in most cases pensions are exempt from inheritance tax. There are potential whispers that they might do something with that, but I've read nothing concrete. But it is something that people worry about. Will the IHT exemption be limited or capped? And I'm not sure, but it'll be something to definitely keep an eye out for. And I think it'll be interesting to reconvene after the first sort of budget, or probably the autumn statement, and see what materializes into actual law and actual legislation.
Yeah, absolutely. Yeah, I mean, in terms of the protecting from IHT, probably the least important tax relief associated with EIS is the business relief qualification, i.e. it's
forgot to mention that.
I'm there for you, Charlie. The business relief means that if after you've held the shares for 2 years, there's no inheritance tax charge on that asset, yet you keep control of it, so it's quite flexible. It's there. It's especially useful for that kind of 5 million and under category, because it is very accessible. And there's a number of different ways, products out there and investments that you can access it. And the government is unlikely to change it, because that would be a real can of worms to try and unwind that, especially with its impact on the AIM market. But yeah, that was just something we hadn't discussed really with the IHT thing.
Okay, I'm aware that people need to head off. So final thoughts on what you'd actually like to see or not see. I think for me, those changes to auto enrollment, widening who gets brought into it and increasing the percentage of contributions is a definite. Just thinking about all my clients, I'd really prefer that the IHT status of pensions isn't touched. That would be my wish. I know it's like something not to happen, but that's probably where I'd come down on. Any wishes from the rest of you?
I suppose in general, just my overall wish is for a bit of stability. I'm really liking the kind of the growth focus that they're having, but the last few years have just been characterized by massive instability, kicked off by David Cameron and the Brexit referendum, but since then it's been unrelenting. And the most recent inculcation of the Tories under Rishi was no better. Changing deadlines hit left, right, and centre, and cancelling big projects, all kinds of things. It's made the UK not seem that attractive as a place to invest, when actually the fundamentals are that the UK is an exceptionally good place to invest, with absolutely incredible professional services, the kind of well-beating universities, great infrastructure, amazing legal system, all these kind of things that people forget about, and yet the bad headlines have just dominated. So, but it's stability, so that the rest of it can shine through.
Wholeheartedly agree on that. Anything from you, Anton or Heledd?
I was going to say ladies first.
Go for it.
Well, thank you very much. I think stability's got to be, crucial. So I would absolutely echo Simon there. But I think clarity on what, tax limits are, clarity on what care costs, caps, that, that people actually understand where they might be required to personally invest, so they can make informed decisions early enough on. So whatever the outcomes are, and we await with interest, actually making it clear to people that this is on you. This is on you. You need to understand this, and you need to go and get that professional advice early to understand what works for you.
Yeah, I agree.
I'd like to see a government that implements tax policy for the benefit of the economy as opposed to political tax changes. So I'd like to see the fact that this economy backbone is 85% small to medium-sized enterprises. I'd like to see the government support that by giving incentives for those companies, hopefully then impacting on GDP, increasing obviously GDP and the tax take to the country that then can be invested in all the good things that they want to do from a political point of view. And the other point is that previous governments and this government have all put their thoughts forward on how to tackle tax avoidance, and being a specialist in that particular area, and writing for Tolly's and having that line of communication with HMRC at Fraud Investigation Services Deputy Director level. I'd like to see them actually be clear on tackling avoidance through the changes that the Treasury introduced to legislation, because historically it's been pretty shambolic. They're still dealing with stuff now that they brought legislation in to counter in 2010, and they can't get cases settled because they don't have the infrastructure for it. So seeing a more streamlined basis to tackle avoidance and actually see it through, that it is efficiently dealt with for the benefit of the taxpayers as a general, would be a godsend, and obviously increase my business, which would be fantastic.
Awesome, guys. Thank you so much for jumping on. I really appreciate it. I'd love to do this again when we do have some more detail. But in the meantime, thanks a lot, and hopefully catch you all at one of the events soon.
See you soon.
Thank you, Ed. Bye.
Thanks, Charlie.